And welcome back. Thank you so much for joining me in today's video because this is actually the most in-depth analysis regarding our US housing market I actually have ever seen based on Black Knight's latest mortgage monitor just announced today, which is November 6th here. I want to share this quote from Andy Walden, who's the Vice President of Enterprise Research at Black Knight. By the way, Black Knight was acquired by ICE for $12 billion in September. So this report is technically from ICE, but not Black Knight. Anyways, according to Andy Walden here, it says for all but one single day for October, interest rates spent the entire month above 7.5%, topping out at 7.8% as of October 25th. Mortgage rates haven't been that high in 23 years, which continues to hammer affordability. The situation was already dire, but recent weeks have seen rates climb to where it now takes nearly 41% of the median monthly income just to make the P&I payment needed to purchase a median price home. So to summarize that, to buy a median price home today, your average payment to income ratio is actually at 41% right now. Also, your average housing payment has now risen $144 more per month over the past 30 days. And now it sits above $2,500 a month for the first time in history. So housing affordability is at all-time record lows. Keep this in mind though, the record high payment does not include taxes, insurance, or HOA dues. And as I reported to you guys, the premiums that people pay to buy home insurance right now are about 35% higher compared to about 2 years ago. Big increases in premiums for home insurance. And by the way, they mention here for the last 35 years, the share of income needed to cover P&I or principal and interest payments has averaged below 25%. And now it's at 41% right now. Affordability pressure is not coming from interest rates alone. The last time affordability was this bad was way back in the 1980s when rates were in the double digits. I have some stats to share with you regarding that here in a little bit. And back then, the average home was about 3.5 times incomes. In stark contrast today, the price to income ratio is nearly 6-to-1. So it's pretty crazy. We have all-time record lows for housing affordability. And given the fact that back in the 1980s, we had rates over 13%, and housing affordability is worse today than it was back then. And that's really due to the rise in rates, but also due to high home prices as well. So that is a brief snapshot regarding this report here, but I have a lot more to share. Some pretty crazy stats here. For one, for example, I'm going to share towards the end of this video here that most of the people doing refis right now, the vast majority are doing a cash out refi and taking on a higher rate than they already have. Pretty wild. I have some news to share regarding that. Anyways, the ICE mortgage monitor, of course, it used to be the Black Knight monitor report, provides a variety of issues related to mortgage finance and housing industries. And as I mentioned back in September, ICE purchased Black Knight for $12 billion. Absolutely crazy. Okay, let's first talk about mortgage rates because that has been absolutely all over the place for quite some time now. So according to Black Knight here, it says the lock index increased to 7.8% on October 25th, spending all but one day in October above 7.5%, as mortgage rates, of course, hit 23-year highs. Something I mentioned in my video from about 1 week ago is that the spread between the yield on the US Treasury note or the yield on the 10-year US Treasury note compared to mortgage rates is much higher right now compared to historical averages. So in general, the spread between the 10-year and the 30-year fix is around 160 basis points or 1.6 percentage points. But right now it's around 300 basis points, or to be exact, around 280 basis points. And this is due to the following here because we have a lot of volatility right now in our housing market. And that's one of the main reasons why we have this big disparity in the 10-year and of course the average 30-year fix. So as I mentioned right here, historically speaking, the spread should be 160 basis points and not 280. And this is due to all the volatility in our housing market. Therefore, 30-year fixed rates should be around 6.2% right now, given the 10-year treasury yield is around 4.6%. But instead, rates are around 7.4% right now, at least as of Friday, due to this wider spread. So big picture here, because the spread is so much higher compared to historical averages, we're at high rates at around 7.4%. But given historical spreads between the 10-year and the 30-year fix, we should be around 6.2% right now. They also provide their forecast for the remainder of the year and also into 2024. The rate forecasts have risen more than a percentage point in recent months. Projections are now calling for the 30-year fix to end 2023 at 7.25%. Then for the entire year of 2024 to be at 6.4%. Compare that to their forecast back in June. They were forecasting to end the year at 6.09% this year and at 5.25% in 2024. So they're forecasting now for rates to be much higher compared to the forecast back in June. Now, here's a really good chart showing the 30-year fixed rate, which is this blue line right here. And the black line is the yield on the 10-year US Treasury note. So as of, I believe this is actually through the end of October here, the 10-year was around 5%, but rates were very close to 8%. So the spread was about 280 basis points, which is right here. The left axis is the spread here. Historically speaking, though, again, the spread should be around 160 basis points. So for example, from 2017 through about 2019, the spread again was around 160 basis points, but now it's at around 300 basis points. Okay, let's now talk about housing affordability because that dropped to a new all-time record low here. Which sits with rates at 7.79% as of October 26, according to Freddie Mac. It now requires a monthly P&I payment of $2,567 per month. And that's up $144 from the previous month in September and up a whopping $1,240 or a giant increase of 94% over the past 2 years alone. This is actually the first time the median monthly payment has increased over $2,500. And again, this excludes the increases in home insurance rates and of course, property taxes as well. It now requires 40.6% of the median household income to make the monthly housing payment of P&I on the median price home, making housing the least affordable since it's ever been since 1984. I have a note regarding this because this is absolutely crazy because back in 1984, the range of a 30-year fixed mortgage rate was in the range of 13 to 15%. So it's pretty wild to see that housing affordability is at the lowest levels since 1984 when rates were so much higher than compared to now. What this really is telling me is that even though rates are around 7.5% right now, home prices are still very much high. That's one of the main reasons why we have all-time record low regarding housing affordability. So for example, over the past 35 years, that payment to income percentage, which again is at 40.6% right now, that historical average is just under 25%. So people are getting much more leverage right now compared to previous years here, of course. To get back to the long-term affordability levels, this is pretty wild here. So they're basically talking about here how do we get back to more historical averages regarding housing affordability here? It would require some combination of a 4.4 percentage point decrease in 30-year rates. Get that. We have to get, in order to get to more affordable or more historically affordable ranges, we need a combination effect of rates decreasing by 4.4%. On top of that, a 62% increase in household incomes or a 38% decrease in the median home sold price. To me, this is absolutely eye-opening to see that in order to get to a more normal range regarding affordability, we need to see interest rates decrease by 4.4 percentage points. So that would mean that rates would be around 3%. On top of that, incomes increasing by 62% or prices decreasing by 38%. That is more than the decreases in prices we saw during the Great Recession. Okay, let's talk about the most affordable markets nationwide and also the least affordable markets as well. So it says housing affordability remains a challenge across every major metro. The most affordable market nationwide is actually in Cleveland, Ohio. In contrast, the least affordable market nationwide is actually in Los Angeles. The least affordable markets continue to be in coastal areas, primarily in California and Florida, with New York, Nashville, Tennessee, Las Vegas, Seattle, and Salt Lake City, Utah, rounding out the list of markets most stretched from the long-term averages here. So take a look at this. Here's a map, of course, of the US here. It says the payment income ratio change. So this is the change from historical averages here. And the areas in dark blue right here is severe rise from the benchmark. So an increase of over 25 percentage points. This is pretty wild because the coastal markets, which would be, of course, the San Francisco Bay Area, Los Angeles, San Diego, for example, huge increases in your payment income ratio compared to the benchmark. So for example, in Salt Lake City, Utah, an increase of 20.5 percentage points. Los Angeles, California actually is the worst metro nationwide, a giant increase of 40.9 percentage points higher compared to the long run average. Miami, Florida is also one of the top here as well, an increase of 30 percentage points. In regards to Miami, Florida, that ranked as the 5th least affordable market in the United States here. So the payment income ratio is at 54.3%. The payment income ratio, the average from 1995 through 2003 is only 24.4%. It's actually much worse in Los Angeles. 76.5% is your payment income ratio here. The average is at 35.6%. After Los Angeles was San Diego, San Jose, and San Francisco. In contrast, the most affordable market was Cleveland, Ohio. Your P&I payment, 25.5% compared to 76.5% in LA. And also, this is slightly higher compared to long-run averages in Cleveland at 21.6% versus 25.5% right now. They also provide a summary regarding what we're seeing right now regarding housing inventory. So active listings, or the number of houses for sale nationwide, has begun to rise modestly in recent months, and while still sitting about 45% below pre-pandemic levels, are nearing levels of last year when prices began to weaken. I've been talking about this, right? Inventory levels are still increasing right now, which is highly unusual. Inventory levels should be decreasing, but in fact, they're still rising. It says while demand is falling and supply is improving or increasing entering Q4, the net result is likely to be slowing sales volumes or a decrease in home sales and softening prices as we move through the remainder of 2023. I've been talking about this as well. We tend to see a decrease in prices as we approach the winter months. That is seasonality. But coupled with the fact we have all-time record lows regarding housing affordability, high rates and high home prices, I've been saying this over and over again, that I imagine that we'll see a sharper pullback in prices for the remainder of the year, coupled with seasonality, of course, right? So here's a really good snapshot showing home sales and active listings here. In fact, let me just zoom in here. So this light gray line is active listings seasonally adjusted here. The sharp increase right here, entirely abnormal during this time of year, which is more or less what happened last year, because inventory levels shot up big time last year. And that was one of the main reasons why prices declined so much. Even though back then, the number of houses for sale was way below pre-pandemic levels here. So for example, let me just zoom out again. Back in 2011 through approximately 2018, 2019, we had around 1.5 million houses for sale. Now we actually have less than 1 million houses for sale, and also below 1 million back in 2022 as well. And just under 1 million houses for sale back in the last half of 2022. And despite that, prices decreased big time last year. They also talk about how each of the markets fared regarding inventory levels. It says about 92% of the US cities here have shown inventory increases over the past 3 months, with the remainder experiencing only marginal decreases. At the upper end of this extreme here, Austin, Texas, inventory is now up by 7.5% above its pre-COVID average, the highest comparative inventory level in any other market. So Austin, Texas saw the biggest increase in the number of houses for sale compared to pre-pandemic levels. On the other end of the spectrum though, Hartford, Connecticut still faces a 79% inventory shortage. So here's a snapshot looking at housing inventory compared to the average from 2017 through 2019. So Austin, Texas is significantly above that average here, which is 0% right here. The national average is way down here. So on a national level, we're down about 45% compared to the average same time frame in 2017 through 2019. Miami, Florida is right on par with the national average, but below that was Cleveland, Ohio, San Diego, and of course, Hartford, Connecticut. After that, we had Phoenix, Arizona above the national average, as well as San Jose, Denver, San Francisco, and New Orleans. Okay, let's talk about home prices right now based on the median sold price nationwide. So prices increased by 0.39% to yet another all-time record high on a seasonally adjusted basis for the month of September. On the other hand, though, September's seasonally adjusted rise was the weakest since January and a noticeable downshift from August. So for example, the non-seasonally adjusted prices decreased by 0.3% compared to the previous month, slightly weaker than the 25-year September average. So on a non-seasonally adjusted basis, prices decreased by 0.03% compared to August. That is slightly weaker compared to the 25-year average from August through September each and every year. With 30-year rates threatening 8%, housing affordability at a 38-year low, and purchase applications, of course, decreasing to the lowest level since 1995, it's fair to expect prices to weaken as we move into late 2023. Again, due to seasonality, but also all these headwinds we're facing right now. One thing I will mention is that rates decreased big time last week. So right now, rates are around 7.5% compared to the 8% rates we saw about 2 weeks ago. I would imagine that's not going to cause a huge increase in home buying demand, given the fact that home prices are still very high, of course, at 7.5%, much higher compared to just a few months ago as well. Okay, let's talk about home prices for each of the major markets nationwide for the month of September here. I know this is November, by the way, but this is a ton of data to compile. So it takes Black Knight or ICE quite a bit to formulate all the stats here. So it says here, Hartford, Connecticut continues to see the strongest year-over-year price gains, a gain of 11.7% compared to September 2022. That was followed by Milwaukee, Wisconsin, Providence, Rhode Island, Cincinnati, and Philadelphia. In contrast, there was actually 5 markets that saw a decrease compared to 1 year ago. Austin, Texas led the nation once again, a giant decrease of 9.3%. And in fact, here's the 10 markets that saw the lowest home price growth from September last year through September this year. Austin, Texas, basically leading the pack here by a long shot, down by 9.3%. Then we had San Antonio, Texas, down by 2.4%. But only 5 markets, which is New Orleans, Dallas, Salt Lake City, Utah, San Antonio, and Austin, Texas, down year over year. All the other markets are actually up. In contrast, the biggest increase, again, Hartford, Connecticut, up by 11.7%. Then we had Milwaukee, Providence, Cincinnati, Philadelphia, etc. Black Knight also provided some stats regarding how many people are actually underwater on their mortgages here. So as of September, 383,000 or 0.7% of all mortgage holders were underwater on their houses, meaning they owe more on their loan compared to what their house is actually worth. That's less than half the share prior to the pandemic though, and in the early 2000s before the great financial crisis. Austin, Texas, where home prices remain more than 14% below last year's peak, is the worst position of all markets with a share at 2.1% of all mortgage holders or homeowners who have loans on their houses who are actually underwater. After that was Las Vegas at 1.7% and Phoenix, Arizona at 1.6%, well above the national average at 0.7%. San Jose, California, despite its home price struggles last year, and Los Angeles had the lowest equity share at 0.1%. So here's a chart showing the amount of people who are underwater on their loans, which is the blue shaded area here. So right now it's virtually non-existent at, what was it again, 0.7%, which is below levels compared to the run-up of the Great Recession and also lower than prior to this pandemic here. So this is very, very low levels right now. Of course, way below the levels we had back in 2007 through 2010 as well. All right, lastly, let's talk about the people who are refinancing right now and taking on a higher rate. So the vast majority, what is it at 90%? So 90% of all the people who are refinancing their mortgages right now are doing a cash out refi. This means that 9 out of every 10 people doing a refi are doing a cash out refi and taking on a higher rate. Absolutely crazy here. So I have some news to share regarding this. So as of Q4 of 2022, according to an article from Redfin, 82.4% of all people with a loan on their houses had a rate below 5%, compared to the average rate for September at 7.2%. So people are trading in their lower rates right now for a higher one in order to get the money out of their houses. And they're doing this because they need money. One of the reasons why people need the money is this right here: revolving consumer credit at all-time record highs. So the total number of revolving debt right now, which is more or less credit card balances at all-time record highs, at just under $1.3 trillion for the month of August, the most recent stats we have from the Board of Governors of the Federal Reserve System. So when we zoom out over the maximum time period, which goes back to the late 1960s, we have all-time record highs for credit card balances nationwide. So this is one reason why 90% of all the refis right now are doing a cash out refi, even though they have to take on a bigger rate or a higher rate. Now, one thing you guys should be aware of though, is that even though that share is very high, 90% of people doing a cash out refi, is the number or the actual amount of cash out refis is still low. So the share of cash out refis is very, very high, whereas the amount of cash out refinances right now is still very much low. So for September, this is this right here. When looking at 2020 through early 2022, we had a very high amount of people doing refis, whereas right now it's very limited to say the least. But the difference between the share of cash out refis right now compared to back in 2020 is night and day difference here. So back in 2020, for example, the share of people doing a cash out refi was around 40%. Let's actually call it around 30%. Now it's at over 90%. To me though, even though the amount of people doing a cash out refi remains low, the share of people doing a cash out refi and taking on a higher rate really tells me the challenges that people are facing right now because they need to get the money out of their houses in order to afford to basically pay for everyday living expenses. That is personally my biggest takeaway from today's video. But of course, there was a lot of information I went over in today's video. So please leave a comment below with your biggest takeaways. If you guys are still watching today's video, I appreciate you very much. By the way, hope you have an awesome day and look forward to seeing you in the next video.